With interest rates on the rise, you're probably asking yourself, how can I get a lower interest rate? Well, after you watch this video, you will know 5 easy ways so that you could save money on your future mortgage payment. My name is Tommy. Let's do this. The first step is see if you qualify for an adjustable rate mortgage. An ARM is a home loan that has an interest rate that adjusts over time based on the market. ARMs normally have lower interest rates to start compared to fixed rate mortgages. ARMs have 2 different periods, a fixed period and an adjustable period. Now, the fixed period is usually like the first 5, 7, or 10 years of the loan, and after that, the adjustment period starts and your interest rate can either go up or it could go down depending on the benchmark. For example, a 30-year loan with a 5-year fixed period will stay at a fixed rate for the first 5 years and adjust for the remaining 25 years either up or down. This loan product can be a great option if you want the lowest rate possible, and who doesn't want that? An ARM can lower your monthly payments with a lower interest rate and make owning a home just more affordable from the start. So you might be a great candidate for an ARM based on the next following things. If you know you're moving before that adjustment period starts, then you could save a lot of money. Also, if you know your income is increasing in the future, you can always refinance into a fixed rate loan. My key takeaway for you is make sure you know the lifetime adjustment cap. This tells you how much the interest rate may increase in total over the lifetime of the loan. Be careful, because with this type of loan, your interest rate could potentially get very high and make the payments really unaffordable for you. That's why it's important to know the lifetime adjustment cap, to know the worst case scenario in the future if it went all the way up with that interest rate. The second option is for you to look at getting a shorter term mortgage. So instead of getting a 30-year fixed mortgage with a higher interest rate, you could look at a 15-year term mortgage, and the rate is usually quite a bit lower. So the benefit is you pay half the interest that you would pay on a 30-year fixed loan, right? It's half the time. So you could save a lot of money on interest, but your payments will be higher. Usually to qualify for this kind of loan, you need a better credit score and financial health. So with this kind of mortgage, you could build equity quicker and get a lower rate. Also, if you need a lender, I'm licensed in California and I would be happy to help you. My contact information is below. And the third option to get a lower interest rate is to hit that like button if you're finding this video valuable. Thanks. But seriously, the next option is to buy discount points on the loan. So what discount points do is lower the interest rate by paying upfront fees. In essence, discount points are actually prepaid interest, and by paying the discount points up front, you're giving the lender a portion of the interest payments now in exchange for paying less interest on your monthly mortgage. A good rule of thumb for you is 1 point decreases the interest rate by around 0.25%. For example, on a 30-year fixed mortgage, it's around 5.5% right now for interest rates, and it would take 6 discount points to reduce that rate from 5.5% to 5%. So the fee would be around $24,000 on a $400,000 loan. So there are caps on total points and fees for the loan, so you just have to see what the lender offers. And you need to know the break-even point for purchasing discount points, and it varies on every loan. Typically, if you are living in a home longer, it makes more sense to purchase these discount points because then it will balance out and you'll break even and then even make money. The fourth option is sometimes just having a better credit score or money to put 20% down. Or it could be a combination of things like more money down, a better credit score, a shorter term mortgage, and maybe even buying discount points. It's good to explore all your options to see how you can lower the overall interest rate. It's like a game. It's like checkers or chess. The last thing I'd recommend is to shop around your rates. I'm a mortgage broker and a direct lender, so I can offer my clients more different kinds of options and loan products than the typical lender. So it's important to go to someone who has those kinds of options and who could be more creative or think out of the box to get you the best deal on your loan. Ultimately, what matters the most is getting a loan that's comfortable for you and your family, living within your means and not getting into a mortgage that won't let you sleep at night. Now, if you want to learn more about real estate and mortgages, please Hit that subscribe button. Don't forget to like. Thank you for watching.